We could sum up our view on markets in 2022 with this statement. Rising rates impact everything else. We could sum up our view on markets in 2022 with that statement. But why? Okay, it's time for a little math. All assets are valued based on the future expected cash flows, discounted or divided by a rate. When you buy Apple stock, say for $170 a share, that $170 is the sum of the expected future payouts from the company divided by the rate of return that you want to earn for investing in the stock. As the cash flows or Apple's earnings increase as they sell more iPhones, the value of the stock increases. The future expected cash flows go up, the value of the asset goes up. However, if the rate of return required by investors, say to compensate them for higher inflation, increases, then the value of the stock goes down to compensate. This relationship between future cash flows, discount rates, inflation, and the value of an asset holds true for stocks, for bonds, real estate, privately held businesses, anything with future cash flows. Note, cryptocurrencies don't have future cash flows. We'll talk about that in another video. Thus, rising rates in 2022 are going to act as a headwind to the value of investment assets. Okay, no more math, I promise. So let's look at where rates stand today. The 10-year Treasury yield has not yet reached its pre-pandemic levels of around 2%, which means as we continue to come out of the pandemic, rates should continue to drift higher to account for a more normal post-pandemic economic environment and the rising inflation that we've talked about. So the key takeaway, rising rates are perhaps the most important factor as we think about investments in 2022.